Hey everyone, Patrick Jackson with Mann Mortgage. I want to make a quick video today with a market update. Today being 5/5 Cinco de Mayo, since the Federal Reserve came out with their second rate hike of the year yesterday, 5/4. They announced that they'd be raising the federal rate by a half a point. So keep in mind that the Fed raising their rate does not directly affect mortgage rates like it does a credit card or even things like a home equity loan. Um, a rate hike sounds bad for mortgage rates, but in general, a rate hike actually might improve rates because really what it's doing is trying to curb inflation. And inflation really is the number one public enemy right now of mortgage rates. So in March, the Fed, when they had their meetings then, and people probably heard about the Federal Reserve raising their rate. So in March, they raised it by a quarter of a point. Which really at the time, our industry, the mortgage industry, didn't think was enough. We thought they should have raised it more because, again, inflation really is the thing we're trying to battle. So they raised it at a quarter of a point, which was good, but not good enough, and they didn't really react fast. And also, they also announced that they would be selling off some of their mortgage bonds that they had bought during the pandemic. So throughout the pandemic, the Federal Reserve was propping up the mortgage bond market by buying a bunch of mortgage bonds, which kept things a little healthier. So really, when they did that, when they announced they're only raising a quarter of a point and that they were going to be selling off some of those mortgage bonds, that since then the mortgage rates have reacted negatively, and we are where we are now with much higher rates than we were seeing. So yesterday, they raised the rate about a half of a point, or actually a half of a point, which is, again, is a good thing in general. But at the same time, they also announced more details about what they would be doing as far as selling out the mortgage bonds. And initially, the markets reacted really well. I know the stock market was up yesterday quite a bit at the end of the day, and mortgage bonds in our side of things were better off. Today, things have reversed quite dramatically. It's a really bad day for the stock market. I think as of 12:55 Pacific time, looks like we're down about 1,200 points on the stock market for the day. And in the bond market, we're down quite a bit. And we're also up quite a bit in U.S. Treasury, the 10-year U.S. Treasury. And that really is, for people not in the mortgage industry, that's probably the easiest one to look at and kind of get an indication of how things are going for us. If the U.S. 10-year Treasury is up, then that's bad for rates. If it's down, then that's good for rates. And today it's up plus 13 at this point, which is a really, really big number and is not, again, good for mortgage rates. So big picture, we can expect rates to continue to jump, probably up higher as the year goes on until we get inflation under control. When inflation's going to be under control completely, that's, as good as guess as, anybody's guess as good as mine. We're looking at maybe the end of the year, possibly even in 2023, depending on different factors. Obviously there's geopolitical things like Russia, Ukraine. If the pandemic popped up again, obviously that would have an effect. And really a big effect is if we head into a recession, and that seems highly likely at this point. So I hate to be the bearer of bad news, but I definitely wanted to get this market update out there so people in the industry and borrowers alike can know this information and know kind of where we're headed. So again, I hate to be the bearer of bad news, but at the same time, it also means that, if rates are going to continue to go up, generally now is the best time to buy or refi. So keep that in mind. So if anybody needs anything at all, please reach out. Otherwise, I hope everybody has a great day. Thanks a lot.